This might be the most important story of 2025, and almost no one is talking about it. The survival of the US economy could now hinge on one critical decision from Japan. Yes, Japan, America's largest foreign creditor, holding over $1.1 trillion in US Treasury debt, is suddenly in a financial crisis that experts are calling the worst in decades. Remember that just a few days ago, the finance minister made a threat that Japan could use its large holdings of US bonds as a tool to force the US to agree to their terms. As bad as the Greek economic collapse was, the Japanese prime minister is saying Japan is in bigger trouble than Greece. And here's the terrifying part. Donald Trump's policies are making things worse. Despite Japan's loyal support of the US economy through trade, investment, and massive purchases of American debt, Washington has offered little help in return and instead placed tariffs on Japan. Tensions are rising. And Japan might be preparing to pull the plug. Just last Friday, Japan's new finance minister Katsunobu Kato announced he's seeking an emergency meeting with US Treasury Secretary Scott Bessent, specifically to discuss currency instability. But behind that diplomatic language lies something more serious. Japan could be preparing to dump a good portion of its US dollar assets. Because if they are, the era of dollar dominance may be coming to an end. And we may be witnessing the first cracks in a financial alliance that has held up the US economy for over 40 years. Before we dive in, make sure to like, subscribe, and hit the bell. Because what we're about to explore could directly impact your savings, your investments, and even the stability of the global financial system. Japan is no longer just going through a rough patch. The country is facing a serious economic emergency. Its debt has reached 234.9% of its gross domestic product, GDP. To compare, the United States has a debt to GDP ratio of about 120%. Japan's number is double that, and this makes the situation very risky. When a country owes this much money, it loses the ability to make smart choices, especially when interest rates are going up. And now interest rates are going up. Japan's 30-year government bond has hit an interest rate of 3.2%, the highest in its history. This is a major warning sign. Japan has relied on cheap debt for decades to keep its economy moving. But now that it costs more to borrow money, the entire financial model is at risk of falling apart. This crisis is not just a problem for Japan. It could shake the global financial system. Japan's currency, the yen, is one of the top reserve currencies in the world. That means it's widely used by other countries and major banks to store value. If investors lose faith in Japanese bonds, it could trigger panic in bond markets around the world. And things are getting worse because of the ongoing trade war. US President Donald Trump has sharply increased tariffs in 2025, and Japan is already feeling the pain. Its economy is weakening right when global trade is under attack. If Japan, a highly advanced, export-driven economy, is starting to fall apart, it may be the first in a line of dominoes. The concern now is that Japan will not go down alone. It would definitely pull the US and other Western economies along in its fall. In the first quarter of 2025, Japan's economy shrank by 0.7% when adjusted for inflation. This is not new. Japan has faced repeated recessions over the past 2 years. In fact, 2023 already had 3 straight quarters of shrinking GDP, technically a recession. There was some brief hope in 2024 when exports rose and gave the economy a short lift. But that didn't last. Now there's an even bigger threat quietly draining Japan from within: its aging population. Perhaps the biggest issue is that the country's population is getting older and its economy is barely growing. This means Japan has to spend a lot more on Social Security, things like pensions and healthcare for older people, but it doesn't have enough money to cover those costs. It is so bad that Japan's government has just approved a staggering budget of 115.5 trillion yen, which is about $730 billion for the fiscal year starting April 2025, the largest in its history. Social Security costs alone have skyrocketed to an eye-watering 38 trillion yen, up from 37 trillion last year. This relentless increase is a glaring sign that Japan's aging crisis is spiraling out of control, forcing the government to funnel ever more money into pensions, healthcare, and elder care, funds that are increasingly impossible to sustain. At the same time, Japan is pouring 8.7 trillion yen into defense, unprecedented levels reflecting a grim new reality. The Defense Ministry has openly declared that Japan faces its toughest and most complex security environment since World War II. This massive budget hike, driven by an exploding social security burden and an urgent, costly military buildup, paints a picture of a nation pushed to the brink. This social security deficit is the main reason why Japan's government has been spending more money than it earns for many years. In fact, since 1998, the government has had a primary fiscal deficit averaging 5% of GDP. The interesting part is that this deficit is smaller than the Social Security deficit alone. This means if Japan did not have to pay for Social Security, its government budget would actually be balanced or even in surplus. It is no surprise when you consider that almost 30% of Japan's budget goes to Social Security instead of projects with economic advantage. Because Japan's government keeps spending more than it earns, it has been borrowing money to cover the gap. Now, the latest numbers are bleak. Consumer spending was flat, with 0% growth. Exports went down by 0.6%. Imports, on the other hand, went up by 2.9%. That's bad news. When a country imports more than it exports, it drags down its GDP. And if people at home aren't spending more, the economy doesn't get any help from consumers either. In short, Japan is stuck. And it's stuck before the full impact of tariffs has even kicked in. Meanwhile, Japan's finance minister, Katsunobu Kato, has urgently scheduled talks with U.S. Treasury Secretary Scott Bessent during the upcoming G7 Finance Summit in Canada. On the surface, the meeting is about foreign exchange, currency markets, yen volatility, and Japan's weakening economy. But if you look more closely, there's something much more serious going on. Just days earlier, Japan's prime minister publicly admitted the country was in deep economic trouble. Debt is piling up. Government bond yields are falling. The yen is getting weaker and weaker, and now this emergency meeting about foreign exchange is coming up? It is easy to see the direction this is going. The Japanese yen is getting stronger compared to the US dollar. Usually, a strong currency is a sign that investors trust your country. But in Japan's case, it's not helping. In fact, it's hurting. Why? Because when your currency goes up, your products become more expensive for other countries to buy. Japan relies heavily on selling cars, electronics, and machines to the world. If those goods become too pricey, buyers will start looking elsewhere. And that's already happening. Chinese companies are stepping in and offering the same kinds of products at much lower prices. Japan's once unbeatable factories are now facing cheap competition from Chinese exports. The situation is even more dangerous because the US trade war is not just targeting China, it's hitting all Asian exporters. Japan is caught in the crossfire. And now, the US government wants Japan to help make the yen stronger. This isn't the first time. In 1985, the US and other countries pressured Japan into making the yen much stronger under an agreement called the Plaza Accord. That decision caused big problems for Japan's economy for many years. Now Japan fears the US is trying to do it again, but this time, Japan is pushing back. Japanese officials say they don't want to raise interest rates or step in to change the value of the yen by buying it with dollars. Here's the worrying part. This situation is not just about money. It's about trust between two major economies. Japan wants to keep control over its own financial decisions. But if the US feels Japan is doing nothing, it might react in a tough way, by bringing back tariffs, cutting trade deals, or putting new pressure on Japan. Right now, Japan doesn't even know what the US really wants. The upcoming meeting between Kato and Bessent is expected to be more of a let's talk and see session than a real agreement. But that uncertainty makes things more dangerous. Without clear goals, the risk of misunderstanding grows, and with it, the chance of a bigger economic conflict. If the US forces Japan to make the exchange rate of the yen higher, it might break Japan's economy. But if Japan refuses and the US hits back, both countries could suffer. And if Japan stops buying US debt or sells off what it owns, it could shake the US bond market and the global economy along with it. It is important to remember that Japan owns about $1.1 trillion in US Treasury bonds, making it the biggest foreign holder. These bonds are safe investments and help Japan manage its money and risks. But Japan might take a desperate step of selling a large amount of these US bonds. Why? If Japan sells its US Treasuries, the US dollar would likely fall in value. In fact, there are already reports that Japan has been selling US bonds since Trump started the tariff war. In April 2025, Japanese financial institutions sold approximately $17.5 billion in long-term foreign bonds, followed by an additional $3.6 billion in the subsequent week. Analysts believe a significant portion of these were US Treasuries or mortgage-backed securities. This marks one of the largest two-week bond outflows since records began in 2005. The timing coincides with a surge in the yen's value, which strengthened to below 140 per US dollar for the first time in 2025, suggesting that Japan may be using its vast holdings of US debt to influence currency markets and counteract US pressure for a stronger yen. Japanese Finance Minister Katsunobu Kato has acknowledged that Japan's $1 trillion+ holdings of US Treasuries could serve as a tool in trade discussions with Washington. While he emphasized that the primary purpose of these holdings is to ensure liquidity for potential currency interventions, he did not rule out their use as leverage in negotiations. The sale of US Treasuries by Japan has contributed to downward pressure on the US dollar, which has been under strain due to investor concerns over fiscal stability and unpredictable trade policies. Despite rising US Treasury yields, safe haven currencies like the yen have strengthened, reflecting diminishing investor confidence in US assets. This sounds smart in theory, but the effects would be huge. If Japan sells a big chunk of US debt suddenly, it would push US interest rates higher. Higher rates mean borrowing costs rise in the US, causing problems for businesses, homeowners, and the government. It could shake up American financial markets badly and cause uncertainty worldwide. This would be like Japan using its US Treasury holdings as a weapon against the United States. But would Japan really do this? The two countries are allies, but desperate times might lead to risky choices. If Japan decides to sell off US bonds on a large scale, it could create a financial crisis not from China, but from Tokyo. And that's not the only pressure point. Japan's own central bank is pulling support too. For more than 10 years, the Bank of Japan, BOJ, followed a plan called yield curve control. This meant the BOJ bought a lot of government bonds to keep interest rates very low. The goal was to help the economy grow by making borrowing cheap. Because the BOJ was the biggest buyer of these bonds, it kept the market calm and stable. But in 2024, the BOJ suddenly changed its plan. Instead of buying bonds, it started selling them to shrink its very large balance sheet. This was a risky move, especially at a bad time. When the BOJ sells bonds, there are fewer buyers for those bonds, so interest rates go up. Higher interest rates mean it costs more for the government and businesses to borrow money, which can slow down the economy. This problem is worse because Japan's economy is already struggling. The tariffs introduced by the Trump administration are making it harder for Japan to sell its products overseas. These tariffs reduce profits for exporters and hurt Japan's main way of growing the economy. Now, with the BOJ pulling back its support, Japan faces higher borrowing costs and weaker exports at the same time. Unlike China, Japan does not have strict controls on money or political power to push through tough times. Japan's markets are open, and investors are starting to lose faith as bond auctions fail to attract enough buyers. So, how long can Japan keep managing these problems? What happens when it runs out of options? Could a financial collapse be on the horizon? The signs are clear. If Tokyo slips, the whole world could feel it. Thanks for watching and see you in the next video.